I've said it before, and I'll say it again. Trading isn't about catching every tick or predicting what's going to happen next. It's about aligning with the market's rhythm, the points where it reveals strength and the moments when it shows weakness. That's why today I want to talk to you about the hidden psychology behind support and resistance. It ties directly to what we discussed in the previous lesson. The principle that helps you capture meaningful moves by thinking in probabilities, not predictions. Because without understanding where collective belief solidifies or collapses, you'll never develop the trust or patience required to stay with a winning trade. Here's something I've learned from experience. Price action is never linear. The market moves in waves of conviction and hesitation. It pushes, pauses, and retreats, each move revealing something about the mindset of the crowd. You've seen it before. A market tests a level, hesitates, backs off, then either breaks through or reverses sharply. That hesitation, that moment of indecision, is the essence of support and resistance. These levels aren't just technical markers. They're reflections of collective psychology. They exist because traders believe they exist. That's the paradox. The market isn't some mechanical entity. It's a living expression of human belief, emotion, and expectation, translated into price. Have you ever entered a position at a level that seemed safe, only to watch the market slice right through it? That experience reveals something important. Support and resistance aren't guarantees. They're decision zones. They're points where the market reveals information about itself, if you're open enough to see it. Think about this. Many times I've watched a stock press against the same price for days. The crowd insists it won't go higher, but the flow of orders tells a different story. Buyers absorbing supply, sellers exhausting themselves. What looks like a ceiling to most is, to a trader with the right mindset, the setup for a breakout. When that ceiling finally gives way, it often erupts in a surge of emotion, short sellers covering, momentum traders piling in. Support and resistance are not static boundaries. They're emotional thresholds. Breakouts and breakdowns are simply the visible outcomes of a shift in collective belief. But the true skill isn't in catching those breaks. It's in observing how the market behaves as it approaches them. Does price hold its ground confidently, or does it falter under pressure? Do buyers step in with conviction, or does fear dominate? The truth is always revealed in behavior, not in lines on a chart. Most traders think drawing lines gives them control, but real control comes from managing your own reactions to what unfolds at those lines. Here's the deeper principle. Trading success doesn't come from constant action, but from emotional discipline. It's about waiting for alignment, for those moments when the market presents you with clear probability, not random noise. Acting out of boredom, fear of missing out, or the need to be right is what drains both your account and your mental capital. Patience is not passive. It's the most active discipline there is. When you wait for the market to confirm behavior around support or resistance, you're stacking probabilities in your favor. Trading is never about certainty. It's about managing uncertainty skillfully. Now let's connect this to psychology, because support and resistance are as much internal constructs as they are external ones. When a market hits support, traders who bought earlier start projecting fear. If it breaks, I'm done. Stops cluster. Simultaneously, value buyers perceive opportunity. The result? A pocket of tension, belief versus fear, hope versus doubt. Whichever side has stronger emotional conviction drives the next move. Resistance mirrors the same dynamic. Traders who suffered at prior highs see a chance to escape break even. They sell into relief, while new participants rush in expecting momentum. This emotional tug-of-war creates energy that becomes visible in the next decisive move. Support and resistance, then, are the crowd's emotional memory, imprinted on the chart. And the best trades aren't born from guessing which way it'll go. They come from observing how emotion expresses itself when that memory is tested. Watch volume. Watch the tempo of movement. Watch hesitation versus urgency. The crowd exposes its hand every time emotion peaks. But here's the challenge. Can you stay neutral long enough to see it? Most can't. They act because stillness feels uncomfortable. They trade because waiting feels like failure. But in truth, every impulsive trade erodes something far more valuable than capital. It erodes confidence, clarity, and mental focus. Once those are gone, even a good setup won't save you. That's why support and resistance aren't just technical concepts. They're psychological checkpoints. They teach you when to engage and when to step aside. They help you conserve emotional energy for the moments that matter. Support isn't always flat. Sometimes it's dynamic, rising along with price, revealing increasing belief among buyers. Resistance can also slope downward, signaling sustained pessimism. The slope tells you the direction of collective conviction. And beware, the market loves to exploit predictable emotions. False breaks aren't random. They're designed by the collective to punish certainty. The crowd reacts in the same way it always has, fearful, hopeful, reactive. The tools may have changed, but human nature hasn't. So don't make the amateur's mistake of buying every dip or selling every rally. Wait for confirmation, for the market to prove which side holds conviction. Every test of support or resistance strengthens or weakens that level, and when it finally breaks, the move is powerful precisely because belief has been shattered. Think about that. The essence of this lesson is patience. The patience to wait for the market's truth to emerge, and the courage to act without fear when it does. Wealth in trading is not built on prediction. It's built on disciplined observation and precise execution. Support and resistance are more than chart patterns. They're training grounds for your mind. They shape your ability to think in probabilities, to trust what you see instead of what you feel, and to balance conviction with openness. The power of these levels lies not in the lines themselves, but in what they reveal about you, your patience, your need for control, your ability to remain objective when the crowd loses its composure. Trading mastery is not about knowing. It's about not needing to know. It's about waiting for clarity, for confirmation, for the moment when the probabilities finally align. That's when the professional acts, not from hope, not from prediction, but from understanding. Because in the end, trading isn't about being right. It's about aligning with the truth of the moment. And that truth always reveals itself at the boundaries where belief is tested, support and resistance. They enter too soon because they believe the market will stop where it should. They exit too soon because they believe the market can't go any higher. And each time they're wrong, they lose not only money, but confidence. If they had simply waited to see what the market was actually communicating, they would have avoided unnecessary pain. It's ironic, isn't it? In trading, doing less often leads to more. The less you predict, the more you observe. The less you act out of impulse, the more your performance stabilizes. Patience is not just a virtue, it's the foundation of consistent success. Every lasting fortune in the markets was built by waiting for clarity, not by reacting to noise. When a level of support proves itself and a genuine trend emerges, wealth flows to those who have the inner stability to sit through uncertainty. When resistance finally breaks and the next leg begins, profits belong to those who resisted the urge to take the quick gain. The crowd sells the moment it feels discomfort. The professional, grounded in patience, waits for confirmation before deciding the story has changed. That's not a difference in skill. That's a difference in mindset. It's the line between donating capital to the market and compounding it over time. Now, patience doesn't mean paralysis. It doesn't mean you do nothing out of fear. It means you act only when the market provides evidence, not when your emotions demand activity. Have you ever caught yourself forcing a trade just to feel involved? That's not participation. It's impatience disguised as productivity. The professional understands that waiting is part of the job. The real work is mental, sitting in front of the tape, staying alert but emotionally neutral, and waiting for the probabilities to shift in your favor. There's also a deeper psychological benefit. Every time you predict and lose, you chip away at your belief in yourself. You start to doubt your ability to stay objective. But when you wait, when you allow the market to confirm what's true, instead of insisting on what you think should happen, you protect your most valuable asset, your mental capital. You take fewer trades, but each one has meaning. You act with clarity, and that clarity compounds along with your account. Support and resistance are perfect teachers of patience because they force you to wait for feedback. A level may look obvious on a chart, but until you observe the behavior around it, you don't know whether it's a barrier or an illusion. If you're patient, you'll learn to distinguish a genuine defense of support from a weak one, a real breakout from a false one. Prediction blinds you to these distinctions. Patience opens your awareness. Let me ask you something. Do you want to be the trader who guesses or the trader who listens? Do you want to gamble on what you think the market should do or build wealth by allowing the market to reveal itself to you? The real power of support and resistance isn't in the lines. It's in what those lines demand from you. Discipline, observation, and restraint. The markets are designed to test your patience and your belief in control. They move just enough to pull you in, then whip back to shake you out. If you rely on prediction, you'll always be the victim of those traps. But if you rely on patience, you'll see beyond them. You'll wait for the crowd to exhaust its emotion, for the false moves to burn themselves out. And only then will you act when the path of least resistance becomes clear. That's when patience pays. Not because you knew what would happen, but because you waited to see what did happen. The irony is that impatient traders believe they're being proactive, but in truth, they're just providing liquidity for the patient ones. The professional appears calm, almost passive, but when the right moment arrives, his action is decisive. His capital, his focus, and his confidence are intact, and the results speak for themselves. So the lesson is clear. Support and resistance aren't about prediction. They're about perception. They test your ability to wait, to watch, to accept the market's verdict instead of imposing your own. Their power lies not in the chart itself, but in the self-control they develop within you. Professionals wait for confirmation. Amateurs act on contact. That simple difference separates those who grow from those who bleed. The amateur sees price hit support or resistance and assumes meaning from the touch alone. He acts immediately, convinced that the market owes him a reversal because his chart says so. He confuses his expectation with reality. The professional doesn't make that mistake. He knows the market doesn't respect drawings. It respects conviction. He waits for the evidence that shows which side truly holds control. Think about how many times you've seen a breakout fail. Price pokes above resistance, only to collapse back into range. That's the graveyard of premature trades. The amateurs jump the moment the line is touched. They want to be early, to feel smart, to satisfy the ego's need to be right. But the market doesn't pay for ego, it pays for discipline. The professional doesn't need to be first. He only needs to be aligned with the side that wins. So he waits. He watches how price behaves after crossing the level. Does it attract participation? Does it hold? Do the bids stay firm? Or does supply flood back in? That waiting, that quiet demand for proof, is the difference between chasing noise and capturing opportunity. Every false move you've ever fallen for, every whipsaw at support or resistance, was a payment to the market for impatience. Acting on the first touch is the cost of needing to know instead of needing to see. Confirmation can take many forms. It can be price holding above resistance for several sessions. It can be an expansion in volume showing true conviction. It can even be a failed fake-out that reverses sharply, exposing trapped traders. Confirmation isn't about price, it's about behavior. The amateur looks at the number. The professional studies the reaction. That subtle difference changes everything. Now understand this clearly. Waiting for confirmation doesn't mean you'll never lose. Losses are inevitable. They're simply the cost of doing business in a probabilistic environment. But by waiting, you eliminate countless low-quality trades that drain your focus, capital, and energy. The goal of trading isn't to win every time, it's to survive long enough to participate in the moves that truly matter. Acting on the first touch is death by 1,000 cuts. Waiting for confirmation is survival by design. Waiting for confirmation is survival until opportunity. There's also a money management truth hidden here. Amateurs who act on the first touch overtrade. Their accounts bleed slowly from 1,000 small losses. Professionals who wait for confirmation trade less but earn more. Their accounts grow through selectivity, not activity. And here's the irony. Fewer trades often mean greater profits, because you're only exposed when the market is offering a genuine edge. Wouldn't you agree it's wiser to wait for one clear pitch than to swing at every flicker of movement? Another layer of this principle is discipline. Every time you make yourself wait, you strengthen your internal control. You prove to yourself that you can stay calm while others chase illusions. When the confirmation finally comes, your entry carries weight. Not because you hoped it would, but because the market proved it did. Amateurs burn out because their confidence drains after a series of impulsive trades. Professionals build confidence because each patient trade reinforces trust in their process. Take resistance as an example. When price touches a ceiling, the amateur shorts immediately, desperate to catch the top. The professional asks a better question. Are the sellers actually showing up? Is there conviction behind this move? He waits. If price rejects sharply with energy and volume, that's confirmation. If it pauses and grinds higher, that's also information. It shows the sellers are weak. He isn't guessing. He's reading the market's feedback, letting the evidence form before acting. Support follows the same principle. Amateurs buy the first dip, assuming it must hold. Professionals know there's no such thing as must. They wait to see if demand truly steps in. They watch for structure, for multiple retests, for conviction in volume. If buyers defend the level decisively, they act. If fear overwhelms, they stay out, or reverse direction entirely. Confirmation provides clarity, while impatience creates chaos. Do you see the recurring theme? It all comes back to patience. Acting on the first touch is the illusion of control, the belief that drawing a line gives you certainty. But those lines mean nothing without behavior to validate them. The market doesn't care about your chart. It only reflects collective intent. The professional accepts that, and acceptance is what keeps him in the game long enough to thrive. Here's another truth. The market is engineered to test emotion. Why? Because the obvious levels attract the crowd's attention. When price dips to support, stops pile beneath it. When it approaches resistance, breakout orders cluster above. Smart money knows this. They trigger those stops, trap the impatient, and only then reveal the real move. Acting on the first touch puts you inside the crowd's trap. Waiting for confirmation aligns you with the ones who set it. And don't underestimate the emotional freedom that comes with confirmation. When you enter only after the market has shown its hand, you trade with peace instead of tension. You're no longer sitting there wondering, will this bounce hold? Will it fail? Because the market already answered. That clarity reduces stress, and reduced stress means sharper decisions. Clear thinking is the professional's greatest weapon. So, the real distinction between amateur and professional isn't about technique. It's about mindset. Amateurs equate being early with being smart. Professionals know that being early often means being wrong. Amateurs crave action. Professionals crave clarity. Acting on the first touch gives you action. Waiting for a confirmation gives you clarity. And clarity is what pays. Support and resistance are not static lines. They're dynamic, psychological battlegrounds between buyers and sellers. That's the first truth most traders never learn. They draw straight lines on charts and convince themselves the market must respect them like walls. But the market doesn't respect geometry, it reflects psychology. These levels exist because thousands of participants focus on them simultaneously, turning them into emotional zones of conflict. Picture a market that's been climbing for weeks and finally reaches a round number, say 50. It stalls. Traders hesitate. Why? Because 50 is more than a price. It's a symbol. It represents profit-taking for early buyers, anxiety for latecomers, and temptation for those who've been waiting. That hesitation manifests as resistance. The next time price approaches 50, everyone remembers what happened. Sellers prepare, buyers hesitate, and suddenly the number feels solid. But it's not. It's just a convergence of belief. Support behaves the same way. When price falls to a remembered level and buyers step in, that level becomes imprinted in the collective mind. It bounced here before. Traders think it might again. Orders cluster, conviction builds, emotion thickens. But whether the floor holds or breaks isn't about the line, it's about behavior. If buyers step up decisively, support holds. If fear dominates, it collapses. Each test is a reflection of belief meeting reality. Let me ask you this. How many times have you seen price break a key level, only to reverse and trap everyone who jumped in? That's the battleground in action. Amateurs treat the line as law. Professionals treat it as evidence. They wait for the battle to unfold, knowing one side will overextend and reveal weakness. The line doesn't decide, the crowd does. That's why treating support and resistance as precise points leads to endless frustration. The market doesn't move in perfect increments. It probes, it overshoots, it shakes out the emotional and the overconfident. Those false breaks aren't random noise, and they're the market testing conviction. Each spike above resistance or dip below support is a psychological feint designed to expose imbalance. When you understand that, you stop reacting to every tick and start reading behavior. And here's where the psychology deepens. Every time support holds, belief strengthens. More traders anchor their confidence to it, stacking orders and emotion. But paradoxically, each test weakens the structure, like a fortress under siege. Eventually, the defense tires, confidence erodes, and the wall gives way. When it does, the breakdown is violent because shattered belief turns to panic. The cascade that follows isn't mechanical. It's emotional. Resistance follows the same script in reverse. Each time the ceiling holds, conviction grows among sellers until one attack breaks through. Suddenly, those same sellers are trapped, fueling the breakout with their exits. It's belief transforming into surrender, and surrender creating momentum. The battleground never disappears, it just changes sides. Support flipping into resistance, or resistance into support, is the market's memory reprogramming itself. Traders who were once buyers at the floor become sellers at the ceiling because pain reshaped their perception. They remember where they were wrong and act to avoid repeating it. The opposite is also true. When resistance breaks and later acts as support, the crowd's psychology has flipped. Even volume tells this story. Heavy volume at a test means conviction, one side fighting with force. Light volume means hesitation. Professionals watch volume not as confirmation of price, but as a measure of commitment, of how strongly each army is fighting in the battleground of belief. Support and resistance, in the end, aren't about predicting price. They're about understanding human nature. They're the footprints of collective emotion, fear, greed, memory, and hope, written into the market itself. The professional doesn't need to predict. He only needs to recognize when the emotional balance has shifted. That recognition, patient, disciplined, evidence-based, is what creates lasting wealth. Because in the world of trading, survival isn't about knowing what comes next. It's about waiting long enough for the truth to reveal itself and having the mental clarity to act when it finally does.